Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm excited to have my friend John Griggs on. John, appreciate you joining us today.
Absolutely. Thanks for having me, Mike.
John's the co-CEO and founder of Presidium Group. It's a Dallas/Austin-based multifamily apartment owner, property management company, developer. You guys do capital. Probably go sell you a car or something to you, a little bit of everything. But John, maybe give the viewers a little bit of a background on yourself. I know you came out of California. You're a lawyer. Somehow you decided to get into workforce housing and then transition and development. So maybe give kind of the cheap version of your background here.
Sure. Thanks again for having me.
Yeah,
and
of course.
Appreciate the introduction. So as you mentioned, I was a lawyer kind of in the early 2000s and looking to do something more entrepreneurial. And a friend of mine from law school and I, Cross Moseri, my now business partner, were in California.
Yep.
And we were looking for kind of real estate opportunities there. It's expensive then, it's expensive now.
What time frame is this?
So this is early 2000s.
Okay, good.
So a while ago.
Yeah.
It feels like yesterday sometimes.
That's right.
But we started buying fourplexes in Arizona in 2003 and really just looking to cash flow them with our own money that we'd saved up from being lawyers, and thought, we'll sell them in 10 years and, pay for our kids' college or something.
Sure.
Fast forward, that market just soared as can happen. And over the next 2 years, prices there almost doubled. We saw that as an opportunity, and we also saw it as a warning sign where things are getting a little frothy. So we sold out of that market and quit our law jobs and started looking for how do we do this on a larger scale. And at that point, kind of like today, there was a fair amount of froth on the coasts and some kind of high price markets. And Texas was one of these places that was still reasonably priced, lots of job growth, lots of population growth, just a good place to do business. So we started putting together partnerships here and bought a bunch of units between 2005 and 2007 with kind of a light value add model, which was kind of what was the predominant focus those days.
What do those deals look like in 05, 06? Like what like size, age, stuff like that? Yeah,
kind of 70s and 80s deals that would be, 150 to 300 units. Back then you're buying for 20s, 30s, 40s a door. And you made it work. And what's interesting back then too is people weren't renovating to the same extent they are now. And I think that we can go to that later, but it's a good development that we've gotten more focused on kind of presenting quality products to tenants.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
Yeah, well, at that time too, I mean, everyone like fog and mirror could buy a house, and that's why your fourplexes in Arizona were doubling in a 2 or 3 year period. So it was a tougher time to be a landlord, to be honest with you, back then than what it's been the last, say, 10 years in a lot of ways, because the demand just wasn't there and the rental rate growth wasn't there in our market because everyone just buy a home. So and then you kind of transition. What was I always like talking to people because a lot of people that watch the show probably have just been in the business the last few years with, the popularity of our industry really growing with shows like this and people getting exposure to it. I just didn't simply have the exposure to it, 10, 15 years ago. What was it like from like 08 to like 2010? I mean, 2010, my recollection was probably the bottom of the bottom. That was the worst year to be an operator. What was that like to try to own and operate and try to manage your way through that?
Yeah, no, I mean, it was a super challenging period and definitely the worst, in multifamily real estate. Thankfully, this last period was not nearly as bad. I mean, it was really kind of, if you imagine the last sort of 5-6 years, kind of going in reverse, lately. And again, the last period's been an anomaly, but every month your rent roll gets a little higher, your occupancy kind of stays high. And there it's just getting a little bit worse and sometimes a lot worse every month. And you're kind of wondering, when does that bottom hit? What it forced us to do was just really get involved in the operation side and to squeeze every, piece of juice you can out of the turnip to make things work. And it turned out to be a good experience from that standpoint, an education, kind of a priceless education that, here's how you operate in the worst of conditions. And here's how you kind of look at things when everything looks good and say, well, what happens if there is a little bit of a downturn, and how are you ready for it? So it was a good education from that standpoint. And it'll always be sort of ingrained in my memory is, that things can happen, and there's you got to be ready for it.
That's right. So you coming out of the Great Recession, did you guys buy much stuff between say 08 and 10, or did you just really kind of 11 really. Going forward is kind of when you started kicking it back up?
Exactly. Yeah. I mean, 11, 12, we kind of got back into it, and that was kind of when we really established a programmatic value add platform. And kind of went full speed ahead in the Texas market.
So you guys focus on, I don't think I did a good job on the introduction. You guys focus on Dallas-Fort Worth, you focus on Austin, been in Houston, been in San Antonio. Are there any other non-Texas markets you guys participate in?
There are. So now we're active in Florida as well. We have 2 developments in Jacksonville. We'll have a couple more, hopefully breaking ground this year. And we're closely looking at Phoenix and Tampa.
And then
and also Maine. We have some products up there. So it's
how did you get to Maine?
We met a couple guys that had some interesting assets there that they were chasing, and we partnered up where we kind of provided the capital backing for them and helped to kind of set up the debt and equity, and ended up kind of merging up and having a little platform. It's a neat market. There's a lot of nuances.
That's the first for me. So as people are watching you, where do you guys sit for like unit count, assets under management? I mean, how many units have you done in you guys, 16, 17-year career?
Yeah, I mean, right now we have a portfolio of about 13,000 units. We've probably sold another 6,000, I guess, over the years.
Nearly 20,000 units.
About, yeah. And then on the development side, we've either built or have under construction a little under 3,000 units.
Got it. So before we get into development, that's kind of really why I wanted to bring you on to have a conversation with you today. You've really taken from doing the buy with the value add strategy, and it's kind of sold out of a lot of that. I think you still own quite a bit of it, and you now are almost exclusively focused on doing ground up development, for at least from outsiders' perception. That's what I perceive you guys doing, at least. Correct me if I'm wrong, but I think that's kind of been an interesting transition. And there's got to be different skill sets to do development than it does a value add. I know you're doing construction in both, but they're completely different, dealing with the cities and all the headaches. But before we get to the development, maybe talk about the last cycle that we guys were still in. I never really ended. It seems like it was going to end. It just keeps going. You're talking about in 2011, 2012, you started buying some stuff. I mean, you're buying 70s vintage, challenging locations in certain respects, and just absolutely crushed it on all these deals. I don't know if there's like maybe a deal or two you could think of that maybe kind of encapsulates what the last 7-8 years have been like for you guys' company in the value add space.
Yeah, no, it's true. What happened really from kind of when we started doing this in 5, 6, 7 to that period, kind of the golden age, as we sort of refer to it as, the ability to push rents just got a lot better, and the ability for tenants to appreciate and afford quality product changed. I mean, it wasn't that long ago in the mid 2000s that the idea of raising rents by $25 or $50 was just unthinkable.
They'd move out immediately, right?
Right. And something changed in that period. I think that obviously this area had a wave of prosperity and continues to. And so when I look at some of the deals that we did, in that period where we'd go into East Dallas or East Austin or Arlington or some of these other places, and you'd go in starting thinking you're going to raise rents by $75 or $100, and by the time you get through it, you're looking at doing a higher level of finish out. You're raising rents $200, $250, even more. And you just kind of had to adjust your mindset to that. And fortunately, kind of the debt and equity understood that too, and kind of shifted their mindset. But that's really by the end of this. I mean, we were, that was kind of our MO, is go in and raise rents, $250, $300, and spend 10, 15, sometimes more, 1,000 per unit doing that. And you'd see whole neighborhoods like the area kind of over by Forest Lane over in East
like
Dallas.
Highlands.
Yeah, exactly. Where you just, things change. I mean, the tenancy change, the ability for people to pay those rents and their, valuing of what you're providing. It just shifted in a short period of time.
Is there any deal you can think of that maybe kind of illustrates it? Something maybe you bought in 13, 14. I know you bought a deal over off of Walnut Hill. I'm trying to remember the name of it. It looked like a Soviet style housing camp.
Some of them do.
With the foundation issues and all that. I think that deal. I'm trying to remember the name of the deal.
You're probably thinking the link kind of at right on 635. So that was an interesting deal, and it sort of illustrates how what's great about this cycle is multiple groups can make money.
Sure.
So we bought that from a group who had bought it kind of out of foreclosure, and it was just really a tough property.
Yep.
Crime elements were rampant and physical issues, and they really kind of firmed it up and got the tenancy under control, got the management under control.
Yep.
Fixed it up and made it serviceable and did exceptionally well and sold it to us at about 4 years ago at a number that felt, kind of fully valued at the time. But we thought there was another leg up. So we went in and put in, 12, 13,000 a unit.
Oh, wow.
And
what vintage is this? The 80s?
So it's late 70s. Yeah. So around 1980. So, and pushed it up that next leg and raised rents $250. And now it's got a great, performance. It stays full. It's very stable. It's very safe. As much as it can be. And so now, it's humming along. And so and of course you've even seen deals where 3 or 4 people can kind of come in and actually make money and the band plays on.
Speaking of that, I remember I was looking at a deal in 2014 that we got awarded, and I ultimately ended up getting spooked on it. It was called Ridgemar Square.
Oh, sure.
And it was 360 units, had 1 chiller, 2 boilers in West Fort Worth. And I got spooked, and then all of a sudden, 2 months later, John and his group buys it. And then you change the name. And I remember I drove through it about a year after I didn't buy it. And I got spooked because of the chiller, really, because it was like 1 chiller, and it was I was told it was supposed to be like in good condition, and it wasn't. And then I remember seeing the temporary chiller when I drove through it one day. I was like, okay,
that's always a telltale.
I was like, at least the chiller, at least my concerns were founded, and John had to deal with that, I'm sure, in August.
Lots of fun.
One year. Let me talk about that deal, because then you ended up selling it to our buddy Scott. Scott ended up selling to another guy. Maybe talk through that story a little bit.
No, that's an interesting one, because that's an asset it's really well located in West Fort Worth.
And it was unique too. It had the different architectural styles.
Yeah. It was originally developed by the Smothers Brothers.
That's right.
It's kind of random. 70s TV entertainers. But we like the location a lot. I mean, you got multi-million-dollar homes just north of there. You're 10 minutes from downtown Fort Worth.
Yep.
Thought this is a property that can really carry the burden of what you put on it by raising the basis, and can get the rent roll up. So we did a lot of heavy lifting and raised the rent roll and boosted it up and made it kind of interesting and fun. And then Scott came in and did another leg up, a renovation.
Changed the name. So you changed the name to Xander? Or was that
was him, yeah. So we were the Realm.
The Realm, that's right.
There were 10 different buildings, and each one had a little theme. And there's like the Swedish building and the Dutch building. It was an interesting.
Yeah, it was. And so you paid probably like I remember I was going to buy it like 28 or 29,000 a unit.
A little more than that.
30ish or something. And he sold it for 50 something. I'm sure.
Like that. Yeah.
I'm sure it's worth 100,000 today.
I if that's what they say.
That's amazing.
Whatever someone will pay for it.
That's right.
That's it.
So speaking of that, I think a lot of it's kind of the debt. The debt's really improved quite a bit over our careers, right? And then the equity too. Have you noticed any sort of changes, or in particular around, say, the equity, because the debt's really gotten better. You got more interest only. You've got the interest rates have certainly come down quite a bit, so it's making these cap rates kind of drag them down as well. And then you're seeing in at least up until March of last year, we had an extremely robust bridge market out there. There's a lot of debt funds, lot of banks that kind of went away, and now it's kind of, I think that's back to maybe not to the same level as it was, but it's certainly unthawed quite a bit. So that's certainly kind of been driven on the debt side. But what about the equity? What's different in the type of capital that's seeking you out today versus say 12 or 8 or so years ago, I guess now?
Yeah, I mean, there's been a couple changes. I mean, one's kind of comical is when we started doing this in the mid 2000s. I mean, equity was skittish about Texas. You'd have guys that would come back and say, "Oh my gosh, in 1991 we lost our shirt in Texas."
Sure.
And they had this kind of recency sort of phenomenon and then over time and after the Great Recession, people thought, well, Texas is actually starting to come into its own. I mean, you've got companies like Toyota moving here and companies like Oracle moving here. I mean, this is becoming a real spot. And so the large private equity groups really started to turn on to Texas,
sure,
who were out in New York or California or Chicago or wherever else, many of whom now have offices in Dallas, which is interesting. But that was very much discovered and remains so. But what's interesting, and there's always been the friends and family component. We all know people that want to invest in real estate, and they come to us, and there's that dialogue. But I think what's really interesting is just in the last few years, sort of the democratization of equity and the ability for small investors, individual investors, to access, quality operators and quality product. And you look at how that develops, and I guess back in the day, it was my parents tell me, if you wanted to buy a stock, you had to call your stockbroker and pay him a 2 or 3% commission to do that. Well, now you don't pay anything. You go online, you do it yourself.
Yeah.
10 years ago, if you wanted to invest in a quality multifamily asset, you really had to know somebody or go through an intermediary who would charge some. And in the last few years, I mean, the internet and crowdfunding in particular has really helped to democratize this, as well as just platforms like yours that get the word out to people who are interested. And
it's amazing to get access to watching. I don't have 20,000 units, or about 10,000 units, about 20,000 units. And you see us talk about, doing these deals as experience, and they can reach out and invest in one of our deals. I mean, it's pretty amazing how that's really transformed the marketplace and really brought a whole lot of eyeballs and a whole lot of potential buyer pools that just weren't here 10 years ago. I mean, it's really amazing. So talk a little bit about this. You've really kind of transitioned from doing a lot of the value add workforce housing in the last 3-4 years. Really, the primary focus of your company has been in ground up development. I saw it today in the paper. Actually, you guys made the Dallas Business Journal as we recorded today. You guys just delivered a deal in Frisco, a senior housing deal in Frisco. I saw them before I drove to the studio today, and I know you guys have one of the most high profile development deals in all of Austin right now. But before we talk about that, what really led the transition? Because you guys were crushing it. The returns on all these value add deals have been great. You get current cash flow to a certain extent on these things. And why are you giving that up to go do ground up development? What drove that?
Yeah, it became kind of a natural evolution as sort of another, the next thing in our business to do. I mean, we sort of had kind of gotten the redevelop or the renovation side kind of locked down, and it's always difficult. There's nuances to it. It's never totally locked down, but it seemed like the next logical step in our business. And so we envisioned it as really another arm in addition to value add. And so we sort of stood up our development team about 5 years ago and hired some top-notch people, and now have a really, I think, a top quality group of folks who have been doing this a long time, and got that part of it. The personnel is a key part. And then started acquiring sites and started acquiring sites around Austin, around DFW, and in Jacksonville, Florida, and some other cities, and started building. And so now we've built, we either have under construction or have delivered 3 in DFW, about to start a 4th, 2 in Austin, about to start 3 and 4 there, a couple in Jacksonville, 1 in San Antonio. So, and we have a lot of sites behind that are coming. So it's been good. It is a much, I mean, it's a different business than value add. The time periods are longer. The upfront cash is a lot more. I mean, you're going to spend $1 million on pre-development for really anything that kind of in that 300 to 400 unit size. So it's it's daunting. I mean,
so what's kind of the different team members that you had to add when you went to development? Because a lot of people that at least I interact with, we all do the same thing. We do what you do, which is the value add. So like, who did you have to bring on your team to be successful in doing these development deals?
Yeah, I mean, so we brought in some folks who were pretty senior, who kind of had 15 or 20 years experience from some established seasoned developers, and they'd kind of learn best practices from them and could bring that to us. And then we brought in a president who's a great guy we met through our first Jacksonville deal, who had personally developed about 10,000 apartment units, mostly in Florida, and who came in as leadership for that and set up the structure and set up kind of the MO for how we do all things development related.
Right. So just a complete different division wing of the company.
More or less. Yeah.
What is the equity for that relative to some of the value add? Is that different, or is it the same pool of equity?
It's slightly different. I mean, some equity groups really want the cash flow, and they're focused on that. So it's a tougher sell to tell them that you're not getting any cash flow for 3 or 4 years.
Sure.
So that's one thing. I mean, most of the larger groups do both. And we're seeing individual investors kind of migrate to it too. I mean, the one good thing about development is if you get it right, and just in kind of round numbers, I mean, building a garden style deal, say here in DFW, you're building it for 155, 160,000 a unit, maybe a little more, maybe a little less. If you lease up, if construction goes as planned, if costs come in,
sure,
you're going to sell that for 190 or 200,000 if you can snap your fingers and do it.
Sure.
You're not snapping your fingers and doing it. It takes 3 or 4 years. So
sure,
you're betting on, there's execution risk, which is what it's our job to mitigate, and then there's just market risk, which is
out of control.
But if there is an embedded margin, kind of looking at going forward, that this is you're sort of building for wholesale and you can sell for retail, that can compress and it can also expand. Sure. And so you don't know, but there is something that you feel good about, that you're kind of building for wholesale, I guess.
Yeah. And so not only have you just done like the greenfield development, you're currently involved in, I'm sure, a multi-decade development down in Austin right now.
That's right.
You ended up buying in a relatively challenging part of East Austin off of Riverside. You bought around 1,000 units. Maybe talk through that story, the development, because you bought those 2-3 years ago at this point.
That's right. So in addition to kind of I guess we look at our development kind of efforts. There's a couple nodes. I mean, one is the one-off, or maybe 2-phase or 3-phase standalone multifamily, and then we have a couple large mixed-use projects that we're doing. One is in kind of near East Austin, Riverside corridor. The other one's out by the Austin airport. And so the one that's River Park that we just kind of announced, sort of the vision for, it's a bunch of older student housing that's in East Austin, that it's actually not that old, but it's not very dense. And the area around there has gotten a lot denser. Oracle moved its worldwide headquarters there now. A bunch of other kind of companies are circling around it. So clearly the highest and best use is not surface park, spread out student housing that's some distance from the university there. So we programmed it and went through a rezoning process, and kind of got all the community stakeholders involved, and had long discussions with governmental and other leaders in the area, and made sure that this is something that would be the highest and best use, but also take into account kind of the needs of the community.
Sure.
And so there's going to be a large affordable housing component. We're going to be delivering a lot more affordable housing than we'll be removing from the market.
Yeah.
And there will be some office component. There'll be some retail, and it should hopefully be a new city center. It's going to take at least 10 years to fully build out. So we're in the beginning stages, but we're hopeful to start moving dirt on that in the next 12 months.
How many acres is it? I know it's a lot of units.
It is. So it's about 100 acres when you add it all up.
It's all contiguous too, right?
Yeah.
That's amazing. I remember I saw when you had the paper a couple years ago when you guys bought it. I was like, man, that's an ambitious program for the guy that owned a bunch of stuff in East Fort Worth.
That's right. Hey, the stuff in East Fort Worth made all that possible.
That's right. That's right. That's amazing. So maybe you're in all the majors in Texas and Jacksonville, and now going to Tampa and hopefully Phoenix. Is there any one market that you like better better than the others right now, or are they generally all kind of doing pretty good that you participate in?
Yeah, I mean, it's been pretty remarkable. I think if it's amazing just looking at today's world, if you think about what two markets nationally would you want to be in? I mean, to be really focused on, Austin and Dallas Fort Worth are pretty good. I mean, they're very different, but I mean, the momentum moving to Texas is it's relentless. And I talked to friends and colleagues in California, and it went from sort of 15 years ago when I moved here, like, wow, that's kind of a big move, huh? That's geez, what's going on in Texas? To 10 years ago, it's like, oh, something's really happening. And 5 years ago, it's like, wow, like I keep hearing chatter that our company might move there. And now you talk to people and they're talking to residential realtors out here looking for houses. I mean, it is, I feel like it's a super cycle that's got, decades of legs, and you're just going to see it continue to strengthen. So we love the Texas markets. Houston hasn't participated to quite the same level, but I feel like there's opportunity there too. And it's sort of had a couple gut punches with weather and with, just the energy market being tough, but you feel like that could take off too, and I feel like that's prime for development. Florida is another great place. I mean, we're kind of actively looking for other developments there, kind of especially in that Jacksonville and I-4 corridor.
Yeah.
So.
Well, now always Houston though, that they always have a storm and oil always busts. So kind of boom or bust or feast or famine market. As we're now in the first quarter of 2021, maybe look back on 2020. Any sort of observations or challenges that you're proud of your company for kind of overcoming, and then what do you see 2021 kind of going forward as your opportunities?
Yeah, I mean, 2020 was obviously a crazy year in a lot of ways, and hopefully. Better times are ahead. We really, from when the pandemic started to really emerge in March, I mean, our focus was really largely on keeping our corporate family and our residents safe. And what could we do to kind of stay on the leading edge of that as this developed? And I'm proud that I think we did the best we could on that front. And then it's really, how do you navigate this on an investment basis? And for the first couple of months, nothing was really happening transaction wise. And we were figuring out which developments we'd want to go forward on. But interestingly enough, assets that we had, we were about to sell or about to put under contract at the start of the pandemic, they all sold over the course of 2020 at, prices that were as good or better than we thought going into it, which is astonishing in some ways, but there's good reason for it. And it ended up that I feel like that this just accelerated a lot of trends that were happening anyway. To my earlier point about just folks moving to Texas and kind of looking for bigger spaces and spreading out a little bit more. It's as wrenching of a year as it was. Hopefully, we all learned some things from the various things that happened in 2021. Last week, notwithstanding. Let's hope is off to a new start here, and we'll, I'm generally optimistic that this is going to be a really good year and it's sort of always darkest before the dawn. I mean, the pandemic's raging now. There's lots of just negative things in the news cycle, but once the vaccine gets rolled out, you're going to start to see people come out from the woodwork again, and I'm optimistic by summer we have a return to normalcy. And there will be a frenzy, in my opinion, of activity.
And so you're going to continue trying to acquire new sites, do new deals. Are you going to focus at all or still try to participate at all in the value add space, or is it just all going to be on development?
We would. I mean, I love the value add space. I'd love to get back to doing more of it again. It's hard for us to make sense of the pricing right now, but to the extent there's opportunity, and it wouldn't even have to be much of a hiccup. I mean, if we saw an opportunity there, we'd go full speed back in. It's fun. It's a great business. It's really it's gratifying to take an older asset and to give it new life and to improve the lives of the folks that live there by giving them a good place to live. So I love it. I think we'll be back into it at some point.
So you and I have both been in business a while. You a little bit longer than me. I was in banking when you were leaving and being a lawyer. But it's been a really good industry for both of us. We've certainly done well, both professionally as well as a rewarding business. As you mentioned, you get to take kind of a broken place and make it better, or a piece of a patch of dirt, and then build something beautiful on it. It's kind of what you transition to. If you're talking to someone that's trying to break into our industry coming out of college, what advice would you give them to try to break into the multifamily business?
Yeah, it's a great business. I mean, that's the first thing I say. Just to your point, it's a fun business. Every day is a little different. You're constantly challenging your mind in all sorts of ways. So really, to get into the business, I think just getting the fundamentals down is key. I mean, learning the modeling, learning kind of the economics of it is important. But there's a couple ways to come into it. I mean, sort of some folks start kind of in the real estate business. Some come into it from banking or law like we did, which is also good to kind of come in with a different perspective.
Sure.
But I would say just learn as much as you can about how it works and drive around and look at the areas you're interested in and see what's happening and get on the ground and talk to people in it and just educate yourself as much as you can. Can't read enough.
Yeah, for sure. And I think my banking background's been invaluable, and I was a banker in the Great Recession, so I got to learn a whole lot of lessons that I didn't have to pay the economic price for by observing other people make mistakes. And I think you were fortunate enough that you got to dodge the Phoenix bullet that was coming at you and got into Texas. And I'm sure that was intentional, obviously. You guys saw it coming. But then some of it wasn't, some of it I'm sure was just dumb blind luck. But
I found that we're better lucky than good a lot in Texas. It's sort of if you're here, you're going to be lucky pretty often.
But you think about it though, you intentionally moved here. I was born here, so I just happened to be born here. But my parents moved before that, and you moved here. And the winds that are back, I mean, you're seeing the migration accelerate. The corporate, just last year, major headlines. The richest man in the world lives right next to your big development. And Oracle moved what is that, a mile, less than a mile from your development? I mean, that's just amazing. But you saw that you chose to be in a market that fostered that type of economic development and job reloads, and it's just you chose to put yourself in the path of progress, and good things are kind of help you cover up maybe some of the mistakes you make along the way as well. It's a really forgiving business. So, but anyways, as we kind of wrap up, I've known John a long time. I've observed him even longer than I've known him. He's a very him and his partner Cross are super good guys. Really top-notch developers, apartment owners. John, if people want to get to know you a little bit or potentially learn a little bit more about Presidium, what's the best way for them to get a hold of you guys?
Oh, absolutely. Appreciate that. Go to our website. There's a contact page. It's presidiumre.com, and you can learn more about our developments and our projects and our investments. And we're always interested to talk to new folks who want to invest with us. And again, I think that's sort of how this democratization of the investing world is going to happen. Or just shoot me an email. It's jgriggs@presidiumre.com, and love to talk to folks who are starting in the business, looking at getting into the business. It's all about relationships. It's fun.
That's perfect. Well, John, appreciate you coming on. So for John Griggs, I'm Michael Becker. I appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.